If you've heard of dividend stocks before, then you'll probably have an easier time understanding the concept of dividend stocks. Dividends are basically the payment that a company gives out to its investors or shareholders. If a company is doing well and generating lots of profit, the rest of the money that they don't need for operational purposes will be given to the shareholders as a form of dividend or payment. But what about dividend stocks? You're probably wondering if they're the same thing or totally different. Let's find out as we go through what the purpose of a dividend stock is and other things you need to know as a beginner in the stock market. Hey, welcome to Stock Market Mate. Today we'll talk about dividend stocks explained for beginners. Before we get into it, subscribe to the channel and hit the notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right into it. You probably know by now that there are different types of stocks in the market. Their general purpose is usually the same, that is to generate profit for investors. However, most of these stocks are different in how they work. Moreover, a dividend stock is somehow the same as the usual way a stock works, however it does have its own different set of rules. Before we dive into those rules and other information, let's discuss a little bit about its definition and background. What are dividend stocks and how does it work? A dividend stock, by definition, is an ownership share in a company which distributes a portion of its profits to its shareholders, thereby allowing them to build long-term wealth through a steady income. Dividend stocks are basically profits earned through these dividends. In other words, they're from the regular payment of the company to its investors. Furthermore, the amount of profit that each investor gets depends on how much shares they own in the company. For example, if you own one stock in a company, then your dividend rate will be $1. Likewise, if you own 100 shares in the company, you will get $100 per dividend distribution. To put it simply, you earn $1 for every share you own. Usually, there are a number of different reasons why a company chooses to pay dividends. But typically, it's a way of sharing the business's profits with its shareholders, although companies may also decide to pay dividends if by any chance they lack business opportunities to reinvest the cash themselves. Keep in mind that companies vary in the amount of stocks they hold. Some companies ultimately have more stocks than the others, especially companies with businesses that are flourishing. Also, not all companies pay a dividend. In sum, what a dividend stock means is that the company is paying you for buying their stocks or shares. Now, they don't literally hand out cash when they distribute the money. As we all know, that's not how the stock market works. Instead, they send the money to your brokerage account or your investment account. When starting on investing, the first thing that any beginner investor must do before anything else is open a brokerage account or an investment account. A brokerage account is a financial arrangement in which a customer deposits money with a brokerage firm, which then executes trades on their behalf. On the other hand, an investment account is a current account linked to a stocks account. Its use includes transferring money between accounts and providing deposit services. These accounts are essential to your investment journey. Moreover, take note that most of the time, dividends are paid quarterly. However, it may also depend on the company's schedule. Key dates every investor should take note of. Before deciding on paying dividends, a company's board of directors have to approve its dividend policy first. Then they can announce their plans to shareholders through a press release or a filing with the Securities and Exchange Commission. Furthermore, there are certain key dates that every investor should be aware of when investing in dividend stocks. Announcement date. This is simply the day that the company announces their dividend plans on whether or not they will pay the quarterly dividends, as well as when they plan on doing so. Record date. This is when they record every investor that holds shares in the company. The investors listed and are recorded as shareholders as of this day will be the ones to receive the dividend payment by the time they are released. Ex-dividend date. The date after which shareholders who were not able to purchase the stock will not receive the next dividend payment. Payment date. This is when they release the dividend money to the shareholders of the company, usually through a brokerage account or investment account transfer. Investing in dividend stocks. If you're wondering how to start investing in dividend stocks yourself, it's actually pretty simple. What you need to do is look for individual companies that pay dividends. A lot of companies pay dividends and have long histories of annually raising payments. However, make sure that the company that you invest in has strong and durable business opportunities. Furthermore, you can calculate a company's dividend yield by taking the annual dividend per share and dividing it by the stock price. Using this percentage or yield, you can compare different companies, mutual funds or ETFs, and figure out where you will get the most return on your investment. For a broader approach, you can also check out a company's funds and see if they have ETFs with high dividend yields. Dividend-paying companies tend to be covered by these funds, so they can be a way to increase income than a typical portfolio. There are certain things an investor needs to look out for when investing in dividend stocks. Such things include taxes, rising interest rates, etc. Dividend income is typically taxed at ordinary income rates on shares held in taxable brokerage accounts, so keep this in mind. You might want to consider owning the shares through a tax advantage account like a traditional or Roth IRA to avoid this. Depending on the account type you hold your dividend stocks in, dividend stocks are taxed differently. In an individual or joint account, you will pay taxes on dividends received as well as earned income. The tax rate on dividends is typically the same as the tax rate on ordinary income. The tax rate on capital gains varies depending on the asset you hold in your income. Strategies to know when investing in dividend stocks. There are two approaches that you can consider if you want to start investing in dividend stocks. Dividend yield. The first approach revolves around purchasing stocks that offer high dividend yields. However, you do need to beware of companies that offer too high dividend yields, as it can mean a lot of negative things, as these companies are usually potentially facing business challenges, which contributes to the dip in their price stock and in turn raises the company's dividend yield. Generally, a dividend yield of 4 to 6% is considered quite good, but this can vary with interest rates and general market conditions. For most investors, a lower dividend yield may not be enough to justify purchasing a stock solely for the dividend income. Dividend growth. The next option is to purchase stocks that have consistent increases in their dividends. They will typically offer a lower yield than high dividend stocks, but they are usually backed by growing businesses. Such information can be accessed from the company's annual report. You can calculate the periodic dividend growth by dividing the current dividend DI by the last dividend DI 1 and subtracting 1 from the result, then expressing it in percentage terms. Conclusion. The bottom line is that dividends can have a huge effect on your portfolio as an investor. They can help generate income during retirement or earlier, as well as can be reinvested in order to increase your overall investment return. If you're considering owning dividend-paying companies, it's going to be a great opportunity for your long-term investment plan. But do make sure to research thoroughly the companies that you want to invest in. As beginners, it's important to do a lot of research so that you won't get lost in all the intimidating concepts in the stock market. Moreover, dividend stocks allow investors to get paid during challenging market conditions, when capital gains are difficult to achieve. The long-term growth of these investments can be a nice hedge against inflation. Unlike other forms of income, such as interest from fixed income investments, they are tax-advantaged, making this an ideal stock for beginner investors. That's about it for today. If you found this video helpful, kindly click the like and subscribe button. Also, you might want to leave a comment below. We love hearing from you. Thank you for watching, and we'll see you in the next video. If you enjoyed this video, you're going to want to watch one of these two videos right here. Enjoy!